Welcome everyone back to Pete's Investing Updates. In this strategy edition, we'll be talking about some blue chip trading strategy using the CCI and some RSI variations. But first, always remember to review the playlists. This is where we review the indices and blue chip share prices each week, and also some strategies which are very important to understand. That's where we cover the simple trading strategy, the average down process, and some money management ideas. As always, if you like the video, subscribe, click the notification bell, and like the video to support the channel. If you want me to review an index or a share price or a commodity or a forex pair, put it in the comments and I'll cover it in a future video. We're not offering financial advice. This is purely an educational video series. Some things to consider. We track and trade on a daily chart since we want to backtest and see results of trades back during the GFC as well as COVID effects and how that impacted our charts. We track and backtest revenue over drawdown requirements as a percentage. This is to optimize our returns with less exposure, and I'll explain what that means in a couple of minutes. Brokerage is included in our backtesting. I use $8 per transaction each time we buy or sell, and revenue shown may change slightly depending on your brokerage costs. And our backtesting transacts with $2,000 per trade. That is, every time you purchase $2,000 worth of shares, whenever you buy an instrument you want to invest in. To increase the revenue or the return, simply increase the amount you want to trade. So you may want to trade $3,000 or $5,000 lots. But we're using $2,000 as a baseline. But beware, this will also increase your drawdown, so ensure you factor that into your money management strategy. Let's get started. So first I want to show you our two strategies we're comparing today. So this is our price chart. I know it's a bit small, but just I want you to focus on the indicators we're going to show down here, and I'll zoom into those in a minute. This is our profitability chart for the RSI strategy, and this is a profitability chart for the commodity channel index. And again, I'll explain the details of that for both of them. First, let's look at this top one, the RSI strategy. You can see here, this is the RSI14, the red lines, and the black and green line is the moving average of that RSI14. So that's a moving average 20. So every time the moving average breaks above the 50 of the RSI, and I've put a little indicator there indicating that happened. So whenever it breaks above 50, a little spike above. Whenever it breaks below 50, it's a little spike down. So this here, it's saying the RSI14 moving average 20 is broken above 50. That's where we enter the trade. In this example, it entered the trade there. So that black arrow shows we entered the trade. Let me just drill on that a bit more so you can. Okay, so we enter the trade back here. Now you'll notice the price chart did go up, which is what we want when we go along. And this shows that the exit, the shares were sold at that black cross. Now, why it sold there was because there's two reasons. Number one, it needed to meet our minimum profit requirement. And this overall average high and low of the last 100 days, this dotted line, indicates that. So at any one of these points between that and that range, it's saying, let me just pause the cursor there for a moment. You'll see there, it says overall average of the last 100 days is 21.4 points. So what it's saying is, at any one of those points, it's got to meet at least 21 points from our start. So if I put a ruler from that's where we opened it, so 21 points, so about there. So if the RSI, and our exit is when the RSI breaks down. Now, if the RSI had broken down anywhere in that range there, well, at minimum, that's where it needs to meet. If our RSI broke down after that minimum point is reached, in other words, down here somewhere, if the RSI broke down below the 50, it would have sold out. Because the RSI remains above the 50, right up until here, that's where it closed out. Now, that happens to be 54 points above our opening, so that's a nice little gain in terms of points. But again, theoretically, if you got to this point, you'll see there, that was 18 points. Look at that dotted line, it's 18.2. So that's where, and that's calculated on every bar, on every day. So theoretically, it would have required to meet at least 18 points in order to get it to that level, at least to close out. But in this case, the RSI kept above the 50 and it kept going and it closed out there, so well above our minimum price target. That's the RSI strategy. The CCI strategy, let me drill down onto this little trade. Let's delete that one. You can see here the trade opened there, indicated by those brown bars, and it closed there. Now the reason that's open there is because the CCI14 has broken above the zero, as it did there, and those spikes indicate breaking above or breaking below the zero. And it kept going in an upwards trend, and it closed out there. Now you'll notice on the CCI, it broke below the zero there, but it didn't close out because it didn't meet our minimum profit target. And again, this dotted line represents 17. So let me draw another ruler from that point. So 17 would have been about there. So because the CCI closed down there, it was under our minimum profit target, so it didn't close out. We kept going, the price kept going up, and you'll notice down here, kept going, and the price at that point was 16. So again, if the CCI broke down there, it would have closed out, but it kept going. The CCI was above our zero, and it closed out there, broke below zero, and minimum profit target was 16 reached. So that's well above our profit minimum, and it closed out. Now you would think, based on that little example, the RSI would have been a better return overall versus the CCI. But what we found is overall, and I've got a table here, this is the CCI logic. So the CCI14 needs to break above zero. The average down happens when the close is less than the average price and the CCI breaks above zero and a minimum gain of the last 100 bars is reached. And then we exit when the MA20 of that CCI crosses down and the minimum gain is also reached. So this is the results of that in terms of the profits for each of these shares and the drawdowns required for each of those. Now the drawdown is simply, if you look at it here for example, the drawdown is simply from the highest profitability point to the lowest profitability point. So in that little example, the highest profitability there to the lowest there would have been 2% or $2,074. That's our drawdown. So that's basically saying that's how much your account would have declined in that little trade there. Likewise here, there would have been another drawdown from that high there to that low there. I won't draw it to save time, but you can get the idea. So just on looking at this share price for Caterpillar, if I look at the complete picture since the start of 2007, again, we want to take in the effects of the GFC during 2008, 2009. You can see there that was in the trade and it declined. That was not in the trade at the time, so that was saved there. And also for 2020, during COVID, when the price declined there, you can see there was minimal drawdown required during COVID. But overall, the RSI exercise developed or returned $5,529 versus the CCI strategy returned $9,234. And that is reflected by the CCI strategy. You can see here for Caterpillar, 9,230, and the drawdown is 2,702. And the RSI strategy, 5,500 versus 2087. But overall, and I won't go through all these shares for the sake of time, they all did various results in terms of drawdown. So you can see here the drawdown is simply the profit or the profitability over the drawdown. So 55 over 2087 is 265% on the RSI example. And the CCI example is 9,230 over 2,702 is 342% for Caterpillar. You can see there the drawdowns for each of the other respective shares. So, in summary, the 400 is the CCI, this is the CCI strategy. The overall drawdown was 188%. So the higher the drawdown, percentage profit over drawdown, the higher that, the better. Versus the RSI strategy was 105%. And that's simply saying 188% is simply the revenue, 39,700 over the drawdown. 21,000. It's 188%. And that 226 average per month is simply that divided by the number of months since 2007 versus the RSI strategy 25,343 over the drawdown of 24,000 is 105%. So less so. So what we're really trying to do is minimize our exposure. So even though they had very similar exposure, this one yielded the best returns. So we're going to stick with the CCI logic and the CCI strategy for our future trading. And I'll be covering further examples of other indicators to test against that. Now, of course, we can change both the CCI and the RSI from 14 to 28 or 20 or whatever else, but I've found that's creating a very similar result in terms of drawdown and profitability. So simply, I'll go back simply to the drawdown we're using for CCI and the profitability. That's the logic there. You can pause the video there and absorb that. And that's the logic and the logic we use for the RSI entry, average down, and exit strategy. Okay, guys, thanks for watching. Hit the subscribe button, the notification bell to get future updates, and hit the like button to like the video. Thanks, and speak to you next time.